Good evening, everyone. Welcome to our UC Irvine Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. We're going to get started in just a few minutes, but I just want to kind of just welcome you to our class. We just are over the top of the hour, so we'll allow the rest of our guests to join us over the next couple minutes. This is a class that we teach every quarter with our partnership with the UCI alumni. Really excited to be able to bring this to you. We get a chance to do this 4 times a year, and we've been doing these classes for the last 7 years with UCI alumni, and really excited to bring this content to you. Tonight's class is very interactive. So as we move through our session, we encourage you to ask questions. You can use the Q&A or chat feature in Zoom. We'll answer those questions on air for you. We are also recording tonight's class, so we're going to share back with you all of the presentation material, but we'll also have this class recorded and up on our YouTube channel by tomorrow morning. Again, my name is Jason Maida. I'll be your presenter this evening. It's really a pleasure to get a chance to be able to share this information with you on this path, hopefully to home ownership at some point in time. Here's a little bit about me, and you can see on screen, but I work with an organization called American Pacific Mortgage, and so I teach classes like this all across the country. I also am the one that works one-on-one with clients to help design their home buying plan and ultimately help them on that path towards home ownership. In tonight's class, here's some of our talking points for this evening. We're going to look at the housing market in just a little bit. We want to take a look at what's going on with inventory levels, but also talk a little bit about interest rates and what's kind of going on in that state of the market. We're also going to go through a budgeting exercise. We're going to look at, what does it look like if I continue to rent today, or if I maybe try to transition into home ownership? What's that going to look like for me? We also spend some time looking at credit, how to look at maybe areas of opportunity in my credit. We'll also then look at various loan programs. We're going to talk about how do we save enough money for home ownership? What are some things that I can do as I prepare for home ownership? And then we'll look at first-time home buyer programs that are available. We're going to look specifically at the state of California. I think most of our guests tonight are obviously in California, primarily in Southern California, but we'll talk a little bit about some first-time home buyer programs that we're very heavily involved in across the market. We'll also then go through the buying process. So after tonight's class, you may say, hey, you know what, this sounds really intriguing to me, and I want to learn a little bit more about how I take those next steps in home ownership. We're going to show you the path towards that. We're going to walk through what we call our 6 steps of home buying. And then we want to kind of talk a little bit about wrapping up tonight's session about how do I get started? So if I want to learn a little bit more how to begin the process, where should I go from here? All right. So I know a few more are kind of filing into our class, so we'll allow everybody to get into class. In case you missed it, again, this is going to be a very interactive session tonight. We encourage you to ask questions. You can use either the chat or Q&A feature within Zoom. We'll get those questions on air. We'll also carve out a little bit of time at the end of tonight's class to kind of go through any questions that we missed. And we are recording tonight's class. This session will run about to the top of the hour. And so we should be able to get you out of class just by about 7 o'clock Pacific time. All right, so let's talk a little bit about buying, and does it make sense for me as a prospective buyer? So I think it's important to, first of all, understand what goes into buying, because this is probably going to be one of the biggest financial decisions you decide to make whenever that comes. Maybe it's in 2025 or beyond, but ultimately it's probably going to be one of the biggest decisions you decide to make. So when we think about home ownership, a few things that come along with that. Well, I do have a fixed budget when it comes to homeownership, meaning from a monthly perspective, I can create a better affordability potentially for myself, but more importantly, stability with my housing budget. So I don't have to worry about my rent going up every year when I renew my lease, right? Even in today's market where interest rates are at elevated levels, down the road, there still will be opportunities for clients to refinance their homes. Essentially so if I purchase a home today in this elevated interest rate market, maybe in a couple years, there's an opportunity for me to help lower my monthly payment. Well, I have the opportunity to do that with home ownership and change that monthly budget for myself. This is an opportunity to grow your wealth. And what do we mean by that? Well, ultimately, wealth for most is in their real estate, right? So as my home increases in value, that value goes up and I pay down my mortgage, I essentially create home equity, which again is going to be probably one of my biggest assets that I have available to me, right? And this asset should grow over time. Now, real estate does cycle, but it should grow over time. Does give me the opportunity to be able to have an asset for the heirs of my estate. And believe it or not, when you purchase a home, there is some tax benefits that can come along with owning a home, potentially deduction of interest. And sometimes when you have energy efficient upgrades on your mortgage, that also can lead to other tax benefits. So what I always like to tell buyers is when we consider home ownership, don't look at it as like a fair comparison of apples to apples, because ultimately there's so many great benefits that are kind of tucked away in home ownership that we can realize and we want to factor in ultimately to our budget. Well, speaking of budget, let's start off tonight's class by taking a look at a buying budget or a home buyer's budget. But I want to compare that versus renting. And we call this our rent versus buying calculator. And we've kind of pre-filled in some of the screen just to keep us on track for our discussion tonight. But I want to walk you through this calculator to kind of think through a little bit more about, all these different things that come into home ownership. They can hopefully make our budget a bit more attainable for us. So this calculator is brought to us by Freddie Mac. You're going to learn a little bit more about them later on in tonight's class. But ultimately, when we think about conventional loan financing, we're either looking towards Fannie Mae or a Freddie Mac loan product. So let's first of all dive into this calculator. We have the rental tab set up here, or the rental section, I should say. So we're going to make an assumption for this particular buyer that we're spending $3,000 a month in rent. We have renter's insurance factored at $15 a month. And then we're going to make the assumption that our rental costs will increase by about 3% on an annual basis. Okay, so that's the rental side of things. And then from a home purchase perspective, if we open up this window, our buyer in this scenario is looking at purchasing a $650,000 home. We're going to learn about loan programs in just a bit, but ultimately, as a first-time buyer, the minimum down payment to purchase without assistance programs is 3% of our purchase price. We also factor in the taxes that we would have to pay on a $650,000 home, so property taxes. We assume homeowners insurance. We also have maintenance costs that go into our home purchase. And then we have the loan information tab. So we generally, I should say, for most first-time buyers, we're going to elect a 30-year fixed mortgage product. We have an average interest rate at 6.875% today. And then we have origination charges. So that's what a lender is going to charge us to obtain financing, right? Now, one of our partnership agreements with UCI Alumni Network is that we actually discount our closing costs by $750 or origination costs by $750 just to add an extra affordability for our prospective buyers. And then we have discount points noted here. Now, let me just explain to you what discount points are. That's when you as a buyer can elect to pay additional funds out of pocket in order to bring down my interest rate. So let's say, for example, today's rates are 6.875%, and I want to pay additional funds out of pocket. I can do that and bring down my interest rate by paying points. Usually 1 point is the equivalent of 1% of my loan amount. But here's the challenge in today's market. So today, to break even on those investments, it generally takes about 4 years to be able to break even on paying additional funds out of pocket. But we're in an elevated interest rate environment today. So most clients will probably consider refinancing in a couple years. So with that said, we don't necessarily recommend paying those out-of-pocket expenses to bring down interest rates because we can't just get a good recoup period as newly homeowners. All right. So, but that kind of explains you a little bit about what discount points are. And then there's other settlement services. We think about title and escrow fees. You might have heard that terminology. We have government fees like recording charges, transfer taxes, and those will obviously be subject to whatever location we're going to purchase in. And then the last tab in this budget calculator is going to look at other assumptions. So we're going to assume that our home can appreciate 4% on an annualized basis. Obviously, that could change depending on where we're buying. Then we look at how long will I be in my home. So our projection is for 7 years. So we're going to say, what does it look like 7 years as a renter versus 7 years as a homeowner? We have the cost of selling my house at some point in time, state and federal tax rates that we're going to apply. And then finally, we're going to include in a savings rate, which of course, savings rates are much better than 1%, but we'll kind of take a conservative approach here. So when we look at our calculator, we're going to first look at what's a side-by-side payment comparison look like? Well, we know we're spending $3,000 a month in rent, right? What does the mortgage payment look like for me? Well, that's $5,500 a month, including principal and interest of my loan, taxes, insurance, probably mortgage insurance, which we'll talk through more later tonight. But ultimately, it's a jump up in monthly expenses, right? But the opportunity, if I kind of do the side-by-side comparison over 7 years, is about $81,000 in opportunity of owning my home versus continuing down the path of renting. Now, how did I get to that difference? Well, a couple things that we've talked about already. One is my home will appreciate hopefully over the next 7 years. That's an added benefit. And two is I could have potential tax deductibility benefits they're going to add to the improvement of buying versus renting, right? And so those are the things we want to think through as we consider home ownership. I think the rent versus buying calculator is a great way to start because ultimately your decision around home ownership is probably going to come back to affordability and budget for yourself, right? So I would encourage you after tonight's class, take a look at that calculator. I think that's a helpful way of kind of beginning that path towards home ownership. Now, let's talk a little bit about the housing market. Obviously, for most of us in the California markets, high cost of living area, we're seeing some interesting trends in the market right now. I mean, currently we're in the first quarter of 2025, but typically we see kind of softer buyer activity, but really 2025 hasn't been the case where we're seeing a lot of buyer demand out there. It's interesting. We usually see buyer activity pick up just after Super Bowl weekend. And that's kind of just what we've seen historically in the industry. However, January, February has been really strong. So a lot of buyers getting active in the market. We haven't kind of quite figured out what that reason is. There's a variety. It could be the geopolitical environment, could be just, the strain of where rent rates are at right now. But ultimately, buyer demand has picked up. The challenge we have a little bit with that right now is just inventory levels. You can see in our chart here where prices are kind of getting pushed up in the greater LA market. You can see, median prices rising. You can kind of take the sales price median out of the equation and just look at kind of trends in prices. Lack of inventory, buyer demand are pushing prices up a bit. Even though historically in the winter months like we're at right now, we can see kind of slower activity levels. Homes are, if they're not priced right, staying on the market a little bit longer. So you can see average days on market is closer to 69 days. When we get into markets where there's a little bit more inventory, properties that are priced properly, you'll see that median days on market start to shrink a little bit. But ultimately, I think the takeaway from where the housing market's at right now, prices in some markets are feeling a little bit of an incline simply from a supply and demand perspective. Lack of supply, high demand, that's starting to push prices up. Now, interest rates will play a role in buyer behavior in the market right now. And we want to kind of give you a look at two different sides of the interest rate equation. One is let's look at historicals on interest rates over the last 20 years. Then let's kind of break it down to where have we been in the last year. And so let's start with the 20-year look back. So this kind of shows you historically where we've seen interest rates. This gray bar here represents the housing crisis of 07, 08. And so we see that major event there in the housing market. And then this gray bar here represents the pandemic. So historical averages of interest rates are probably in the 5.5% range. But, as of today, we're not at historic highs, but we're certainly close to the 20-year highs that we've seen. We've seen a roller coaster of interest rates. I think it's important as we look at this slide just to understand that interest rates, very rarely will get down to, the 3%, 3.5%, 4% levels. The pandemic interest rate levels were absolute anomalies. Of course, we don't want to return back to those levels because ultimately that means something's going on in our world. But I think when we look at interest rates on a move forward basis, we'll probably start to see interest rates to tick down, maybe not too much in 2025, maybe into 2026. And that kind of brings me into the last 12 months of what we see in the interest rate market. And you can kind of see this blue bar here, or this blue line, I should say, kind of represents interest rate activity over the last 12 months. So currently we're average interest rates about 6.8. Interest rates have hit as high as 7.25 over the last 12 months. Going into 2025, we thought we would see interest rates start to tick down, even to get possibly below 6%. But it looks like in the current environment, we're probably going to stay in that mid to high 6 level. Now, I think it's important as prospective buyers to understand why we're here from an interest rate perspective. Well, one is because the Federal Reserve is trying to combat inflation. And, we see it in everything that we do, right? The cost of goods, fuel, super expensive. And so the Federal Reserve has tried to raise the federal funds rate in order to combat inflation. We are seeing signs that, inflation is starting to soften a little bit. And so, that's going to be something that, the Federal Reserve is trying to manage down to 2% inflation. But they're also looking at the labor markets. And last week, we had some inflation reports come out that showed a little bit of an uptick in inflation. That kind of scared off the markets a little bit, so interest rates rose a little bit. But I think we'll start to see things settle down a little bit. The Federal Reserve is set to meet again next month. I don't think we're going to see any rate cuts from the Federal Reserve, but I think as you see that from a consumer standpoint, just know that when the Federal Reserve decides to cut interest rates, it's not a direct correlation to mortgage rates going down. When the federal funds rate is cut, it's going to immediately impact the cost of credit card financing, auto financing, lines of credit, things like that. But it will have a ripple effect into mortgage interest rates. Now, mortgage interest rates are not the same for all buyers, and there's a variety of different characteristics that go into interest rates, things like credit score, product eligibility, the type of loan program that I'm going to select, how much do I decide to finance, what does my down payment look like? We talked earlier, in case you missed it, we talked a little bit about discount points where as a consumer, I can pay additional funds out of pocket to bring down my interest rate. So not necessarily something we'd recommend in today's market, but certainly an option for buyers. And then the term of my loan, which we haven't talked about yet, but ultimately in most markets, if I decide to shrink the term of my loan, that can generally bring down my interest rate options. For most first-time buyers, like we see in our workshops, we're going to elect a 30-year fixed mortgage to give us the most affordability. But at times, clients will consider 15, maybe even 20-year fixed options. As we meet with clients for consultations, we're going to figure out what the right option is for you because we'll build a comprehensive home buying plan for you to figure out the right payment scenario, the out-of-pocket, and ultimately what that leads to from a sales price perspective. All right, so we're going to talk a little bit about credit. And, credit is a big part of building home buying plans for our clients. I think when I look at different plans that we put together for clients, there's usually kind of two areas that we're really focused in on. One is it's going to be around credit because maybe we're trying to pay down debt or try to optimize credit score, but it also can be on the savings side of things where we're trying to save up enough funds for down payment as well as closing costs for our purchase. We're going to talk about savings plans in just a little bit, but I want to spend some time looking at credit. So as a potential buyer, look, things to consider around credit, which is one, each loan program has a minimum credit score requirement. You can see some of those on screen. The FHA product is 580. Conventional loan is 620. Our VA product for our veterans that have eligibility is 620. And then we're going to learn about first-time buyer programs later on tonight. Those all have minimum credit score requirements. The lowest credit score generally is like 580 for most loan product sets. Now, when we look at the credit report, there's various models to credit reporting. There's actually 3 different models. There's the credit card score, which is going to show up mostly in monitoring services that you may elect, like things like Credit Karma or some of the agency monitoring tools. There also is the auto financing model. And then, of course, there's a mortgage model when you decide to make a home purchase. And we're going to talk about that model in just a little bit. But in those risk models for credit agencies, and there's 3 agencies that we all know, TransUnion, Experian, and Equifax, right? So those are the 3 credit agencies. Things like major events in a credit report, like bankruptcies or short sales or foreclosures, those are going to have a bigger impact to my credit score because those are pretty large events. But generally, when you have an event, whether such as that or even a late payment, those are going to have the most impact to your credit score within the most recent 2 years. Now, when we look at credit utilization, which we'll talk a little bit about later, we're going to look at credit balances versus credit limits and, how do we maintain sufficient credit balances and optimize our credit score. We're also going to talk a little bit about account closure, which essentially with account closure, when we close out an account, we're basically stripping away all the history from a credit file. So we want to be really cautious with something like that. In the lending world, we always look at all 3 credit reports or 3 credit scores, but we always take the middle credit score of each one of those scores. So for example, if my highest score is 760, my middle score is 740, and let's say my lowest score is 720, from a lending perspective, we're going to look at the 740 credit score, which is going to dictate our product offering, interest rate, and the cost of mortgage insurance. Now, if I'm going to apply with a partner, and let's say my partner scores are just slightly lower, let's say they're 720, 700, and 680. Well, my partner has the lowest middle score between the 2 of us, which is 700. So that would maybe possibly change up the product offering. Certainly, it's going to change the level of interest rate that we achieve and potentially mortgage insurance. So that's why this credit conversation is really super important during our consultations with clients, because we want to figure out the right way to customize and ultimately optimize a home buying plan for a client. This matrix you can see on screen here kind of shows you how long events will be on your credit report, like maybe a hard inquiry or something like a late payment, or the bigger events like short sales or foreclosures, even a bankruptcy. Now, hard inquiries are something that comes up a lot when I have conversations with client. A hard inquiry generally will stay on the credit report for 1 to 2 years. The most recent 6 to 12 months, probably the most impact to the credit score. One of the things that we do a little bit different as a lender working with clients is we only start with a soft inquiry. The reason why we do that is because many of our buyers on varying cycles of time of buying, meaning some buyers are looking to buy next weekend, some are going to buy next year, right? But the soft inquiry allows us to access the client's credit file without impacting the credit score, which I think is really important, especially for our first-time home buyers. This is kind of the weighting of the credit score model. So we'll kind of start with the top here, which is length of credit. So the longer my credit profile is, the more improved my credit score could be. How much credit am I trying to access is this section here, which is ultimately, am I trying to open up new accounts? Do I have those hard inquiries like we just talked about? That has 20% weighting on my credit score. And then we look at credit utilization, which I touched on briefly. Ultimately, credit utilization is the credit balances you have outstanding versus your credit limits. So if I have a higher credit balance ratio right now, let's say I'm at 80% utilization of credit, that means I have 80% of my active credit limits being utilized right now with balances. If I was working with that client, I would encourage that client, let's try to get those balances below 50% utilization. Once we've achieved that level, then let's work towards 30% utilization. And once we got there, our optimal level is 10% utilization. Now, just as a side note, I want to give you kind of a quick little tip here. When you're managing credit card debt, if you can, try to pay those credit card balances down before the end of your statement date, or sometimes it's called billing cycle date, because the date that shows up on those credit accounts is that date that those credit issuers are going to send out the data to the agencies, TransUnion, Experian, and Equifax. So if you can try to pay down those balances before the end of the billing cycle, it's going to give you a much lower utilization level and in turn improve your credit score. Last section, which is pretty self-explanatory, but that's the payment history, right? So how have I paid my bills? Ultimately, payment history is 35% of the weighting. And if I do have a late payment, it's going to be categorized as a 30-day late, 60-day late, or a 90-plus day delinquency. Keep in mind, the most recent 2 years is going to be the most impactful to the credit score. The more severe my credit delinquency is, the bigger impact I'm going to have to my score. All right, I'm gonna take a quick pause there for our audience. I know we have some of us joining a little bit late tonight, but just want to remind everyone that we're going to send out all this material tomorrow, and we are recording tonight's class. So in case you missed anything at the beginning, you'll get a chance to be able to tune into that later. Before we talk about student loans, I just want to ask if we have any questions from the audience. Again, you can use the Q&A function, or you can use the chat function within Zoom if you have any questions. All right. Okay. I don't see anything in either one of those areas. So let's kind of keep on going. Let's talk a little bit about student loans. And this is a daily occurrence for us where we're having a chance to review student loans with clients. In fact, I was just talking with a client about 30 minutes ago because they have federal student loan debt, which is most debt unless you have private loans. But if you're in forbearance right now, which most federal student loans are because of the pending litigation with forgiveness of student loan debt, then there's a few different ways that we have to look at the student loans. One is if you're in an active income-based repayment plan, we can utilize that payment right away. So if that payment is active and it shows up on the credit report, then we can utilize that for the calculation of your student loan payment. So for example, if I have $75,000 in student loan debt, my payment's $250 per month per my IBR plan, that's what you can use right away. Now, if you have had a previous plan and are now in forbearance, and let's say those payments do not show up on your credit report, then by default, we have to count either 0.5% of the total aggregate balances as the monthly payment for an FHA loan, 1% of the total balances on a conventional loan. So that'd be a Fannie Mae, Freddie Mac loan. So if I'm in deferment or forbearance, I still have to have a monthly payment amount counted towards the student loan calculation. However, the difference is if I have my IBR payment showing up on my credit report file. And it's a little bit of a challenge right now. So that's to my example earlier. So I was working with some clients earlier on that today, because the challenge is, if they're in forbearance, more often than not, the student loan servicer is not reporting accurate payments to the bureaus. And so these student loan servicing companies will not provide a payment for us to validate. So that's where we kind of have the challenge. But ultimately, as a lender, we have to kind of figure out which direction we're going to calculate the payment at. And so that kind of gives you a sense of, what we're seeing from the lender's perspective. Now, I did have a question kind of jump in the chat, and it's something we're going to touch on a little bit later. So in case you have curiosity around the CalHFA first-time buyer programs, we have a full section that we're going to do on that because we're primarily a California class tonight. It's a program called the California Dream for All. So we're going to touch on that a little bit later, but at this point, there is no California Dream for All available in 2025. There is no state budget for it. Now, that may change later this year, but as of today, there is no Dream for All activity. We're going to talk a little bit about more CalHFA programs later in tonight's session. Let's kind of go back to some of the loan programs that are available to you as home buyers or prospective home buyers. These are 5 of kind of the core programs available. We have a conventional loan, which is going to fall under Fannie Mae and Freddie Mac. That has a minimum down payment of 3%. Fannie Mae and Freddie Mac have about 60 to 70% of all originations across the country. Every year, Fannie Mae and Freddie Mac set what we call the conforming loan limit, which is at $82,650. But then there's other areas that you can go to higher loan amounts. We call them high cost of living areas. So Orange County, for example, being one of those, you can go up to basically $1.2 million in loan amount. Now, the difference is when we exceed that conforming loan limit of $802,650, the minimum down payment jumps from 3% down to 5% down payment. Okay, so that's a little bit of the change there. For conventional loans, it does have a minimum credit score of 620. And that first-time buyer minimum down payment is going to be 3%, like I said, up to the conforming loan limit. Conventional loans will work in conjunction with first-time buyer programs that we'll be talking a little bit about tonight as well. The next product is the FHA loan. FHA stands for the Federal Housing Administration. That FHA loan is a government insured loan, minimum down payment of 3.5%, minimum credit score of 580, up to a maximum loan amount of $763,600. Now, there are areas across the country, Orange County, that has higher loan limits that we can access with FHA, but depending on what county you're going to look at, FHA is going to have a set maximum loan limit. With the FHA product, that loan limit does increase as you buy, say, multiple unit properties. So if that's just the 1 unit property loan amount, but if you went to a 2 unit, 3 unit, or even a 4 unit property, those loan amounts increase kind of incrementally. And then the jumbo loan, I did get your question in the Q&A, so I'll just finish this section and we'll go back to your question in just a second. But for the next product, that's a jumbo loan product. That's not going to be a product that most first-time buyers are going to need access to, but ultimately it provides clients more financing that need to stretch beyond the loan limits that we can provide under, say, a conventional loan product. It does come with it a much higher down payment amount, usually 10 to 15% down payment, higher credit score thresholds, and it also has higher asset requirements. Those asset requirements may be called reserves, where ultimately after we contribute our down payment and our closing costs, we may have to have additional funds left over, which are called reserves. Usually reserves are equivalent of like 12 months of my monthly payment. So if I have an $8,000 mortgage payment and it's 12 months reserves, that means I would have to have another $96,000 left in reserves. All right. The VA loan product is going to be for our veterans that have eligibility under the VA home loan product. The VA allows a veteran to have a 0 down payment option. And there's ways that we have a little bit more flexibility from an underwriting perspective, things like expenses versus income ratios, a lot more flexibility there. There really is no maximum loan amount for the VA home loan product. And for veterans that have any type of partial disability, at times there's an exemption from what we call as a VA funding fee. And so for usually for most first-time VA users, there's a funding fee that's 2.3% of the loan amount. But like I said, for those that have exemption, that funding fee is absolutely waived. And then the USDA product, those are going to be for clients that maybe have made the decision to purchase in more of a rural area. So let's say we're going to purchase a property in the desert and it qualifies under USDA. USDA has a zero down payment option with a minimum credit score of 620. But there's two kind of qualifiers really under the USDA product. It's location of property, so it has to be more of a rural area. And two is there are income limits by the household size. USDA might be a little bit more restrictive in terms of the expenses versus income ratios that we might be able to have flexibility into, say, the conventional loan product. But certainly USDA can be a great option for clients as well, too. I wanted to touch on this question we had in the Q&A, which is, how do you look at a couple's credit scores when they are purchasing together? What if one person has a higher credit score and the other has a lower one? So we kind of touched on that in our credit section, but ultimately, we have to look at the lowest middle credit score between both borrowers. So my example earlier was if I have a middle score of 740, but let's say my partner scores a middle score of 700, then we have to use a 700 credit score for qualifying purposes. All right, thanks again for that question. Let's talk a little bit about PMI. So PMI stands for private mortgage insurance. So in financing, there's different forms of mortgage insurance. There's the private mortgage insurance, but there's also mortgage insurance that's government insured. So I want to do a quick little snapshot or look into conventional mortgage insurance versus FHA mortgage insurance. So for PMI, let me just kind of explain to you what PMI is. Private mortgage insurance essentially insures the lender against default by the buyer. So if there's a financial challenge for a buyer, they're unable to make their payments, a lender would be insured against that default. The buyer does have to pay for private mortgage insurance. The private mortgage insurance is going to be based upon a few key factors. One is going to be the amount of down payment for the buyer, what their credit score looks like, and then how much they're looking to finance. Now, there are discounted PMI options for low-income housing buyers that exist, but ultimately, that's kind of how the PMI is structured. There's different ways that you can pay PMI. You can pay some of it up front. You can pay it monthly, which most buyers do. Sometimes you can split that into upfront cost and monthly cost, but most buyers decide to do it monthly because PMI does have a cancellation option that once I reach 2 years in my home and I've achieved 22% equity, I can apply to have the mortgage insurance canceled. Now, if some of you have started your search already, let's say on Redfin or Zillow, and you're kind of doing the payment calculators, there's a bit of an elevated payment level that shows on those sites because most of the mortgage insurance is not calibrated to what the actual factors are to mortgage insurance. So if I show you the example on screen here with a $700,000 loan amount, someone has a 740 credit score and they're putting 3% down, the mortgage insurance is $209 a month. So certainly, probably not as expensive as you might see on some of those sites that maybe show it as $300 and $400. So the higher I can push that credit score, the more I can ultimately increase my down payment, the lesser my cost of mortgage insurance is going to be. Now, on the other side of the equation is government insured mortgage insurance through an FHA loan. So it is government backed. There's two forms of mortgage insurance. One is going to be monthly mortgage insurance, which is a 0.55% factor of the loan amount, regardless of where my credit score is and what my down payment looks like. Then there's also upfront mortgage insurance, which is 1.75% of my total loan amount and gets kind of factored into the amount financed. With FHA loans, there is no cancellation option on mortgage insurance. So, regardless if I have 20% equity or not, I can't cancel the mortgage insurance. Only by refinancing can I absolutely exit the mortgage insurance. So generally, most clients with an FHA loan will use that as a product to access home ownership. Hopefully, as the market changes, maybe credit profile changes, in 2 to 3 years, then we're looking to refinance potentially into more of a conventional loan product. If we look at FHA in that same payment example, $700,000 purchase price, now with the difference with FHA is I have to add in that upfront mortgage insurance premium, which would be $12,250. And then the monthly mortgage insurance is almost $120 higher at $320 per month. So when we do that comparison, I think it's important as a takeaway to understand that, all products have different features and benefits, but they also have different qualifying guidelines. So not all clients will qualify in conventional loans, even though it has a different expense structure. but FHA does give our clients access to home ownership. And then ultimately, as we put plans together for future refinancing and whatnot, conventional can be that opportunity down the road. But the FHA loan, as compared to conventional loan, is going to give a little bit more flexibility in terms of qualifying. All right, we're going to move from products now. We're going to talk a little bit about, and mortgage insurance, we're going to talk a little bit about income, and we're going to go through some employment scenarios because that comes up quite often in my conversations with clients. I did want to kind of give you a little helpful document checklist here. So if you're thinking about getting connected with us for a consultation and want to kind of know about, what things should I start to gather from a documentation perspective, here are the things that you'll need. So usually for most clients, the last couple of years of W-2s, if you're currently working right now, you probably got your 24 W-2 just a couple weeks ago. Last 2 months of bank statements, usually last 30 to 60 days of pay stubs. So that's generally the documentation. Now, if I'm self-employed or I'm 1099, usually we need the last 2 years of tax returns. We have to also show that the business has been filing taxes for at least 2 years minimum. And that kind of leads me into employment. And so we can talk a little bit about that. Usually in verifying employment for buyers, we have to verify 2 years of work or I should say, educational history. And what I mean by that is, some of our newly employed clients that have just recently graduated from college, for example, are just starting their careers, right? And so they might not have 2 years work history, but we can verify past educational background to support a 2-year history. So in financing, we do have to verify 2 years of employment and/or educational history. Now, even if someone's transitioning jobs, so if I've been on my current job for 6 years, right, and I'm getting ready to start a new job next month, even though I'm transitioning jobs, we can still potentially use that new income with a validated offer letter. So we don't necessarily have to be on the job for 2 years. We just have to show that 2-year work and/or educational history. Where that may change a little bit is that if I have dual employment, so let's say, for example, I work in the healthcare industry and I happen to work for 2 separate clinics. Both jobs have a stream of income for me, but I work at one for 20 hours a week, let's say the other one for 30 hours a week. As long as I can validate that I've been on both jobs simultaneously for 2 years, then both sources of income can be used from a qualifying perspective. Okay, so that's where that 2-year rule gets a little bit trickier. I mentioned earlier about self-employed clients. We do have to show 2 years of consistent tax filing. So that's part of kind of the guidelines for eligibility. If you're in a variable compensation position, so let's say I have a base salary, but I also receive bonuses or commissions, RSUs, whatever the case may be. If I do want to factor those other variable income sources into my income for qualifying for a home mortgage, then I have to show that I've been on my job consistently for 2 years in order to use those sources. Last thing I want to touch on here, 2 things actually. One thing is if you do have secondary income, like let's say I work 40 hours a week, but I also work for Lyft on the side as a 1099 independent contractor. If I do want to include my Lyft income or that side employment, that's where it kind of goes back to showing that I've demonstrated being 2 years on the full-time job, but also driving for Lyft 2 years. Now, last thing I want to touch on here is just other sources of income. So some clients, in fact, I had a conversation today with the client, which is if I have like room income from a roommate today, that necessarily won't transition over to using that same rental income when I look to buy my home or try to factor that into my budget. Even if I have like a partner that wants to be a part of contributing to the household expenses, but if they're not going to be on the application for the mortgage, then I can't factor that income into the qualifying. Now, one of the things we look at in determining eligibility for a client is comparing the outgoing expenses versus the pre-tax income. We call this calculation debt to income ratio. The expenses include things like credit card expenses, personal loans, car financing, maybe my mortgage expense that I have in my upcoming home purchase. All of those things are going to be assessed into this debt to income ratio calculation. So for example, if we took the principal and interest, taxes of my new house, my homeowner's insurance that I'm going to be paying. And let's say, for example, I have private mortgage insurance because I'm putting less than 20% down, and I'm going to buy a condo, let's say in Irvine, right? Those all get factored into my housing budget for this debt to income ratio analysis. And then I add in those expenses like credit cards, car loans, maybe student loans. So in this scenario we have on screen right here, you can see someone that has $3,000 in total expenses and they're making $8,500 a month. So in this analysis, that client's debt to income ratio is 35.3%. Now, the question I get is, well, Jason, what's the maximum threshold for debt to income ratio? Well, the maximum we can go is almost 50%. And then most guidelines would like you to be at 45%. And so if you're looking at optimizing your debt to income ratio, or what's the affordability comfort zone, whatever we want to call it, I would say 33 to 36% is kind of the comfort zone. And this is just a metric that we're using to identify eligibility for financing, not necessarily affordability. So those are conversations around affordability that we have during your home buying plan conversation as part of a consultation, because everybody's affordability levels look a little bit different. And so we want to make sure we design a home buying plan for you that's both affordable but also sustainable over time, right? And the last thing we want to talk about as we kind of build a home buying plan in our conversations with clients, we're going to dive into assets for saving for our home ownership plan. And we generally need to save for two kind of areas of home ownership. One is the down payment for our home. We learned earlier in our discussion around loan programs that the minimum down payment is 3% for a conventional loan. Well, we got to save up for that, but we also need to save up for what we call closing costs. Closing costs can be anywhere between 2 to 3% of your purchase price is what we give as a general estimate, but that varies based upon ultimately how we negotiate our contract to purchase with a seller. Now, there's various acceptable sources of down payment to purchase your home. You can use cash accounts like checking and savings accounts. I shouldn't say cash, but validated accounts with 60 days of bank records and checking and savings accounts. Sometimes we can even consider 401ks, 403bs, investment accounts like brokerage accounts can be used. Gift funds are where family members are helping contribute towards your home purchase. That can be absolutely allowed in your home purchase plan. So all of those sources are viable. Now, at the same time, assistance programs can be a great resource for you, which we're going to talk a little bit in just a minute about. But savings can be a challenge for our potential buyers. And we talked a little earlier about two challenges in home ownership, potentially credit or just, expenses in general, but also just lack of savings. So I want to give you a really simple approach to what we call a savings plan in tonight's class. And it kind of looks like this. So after meeting with a client, or let's say we're having a discussion around budget, let's say currently as a client, I'm spending $2,000 a month in rent, right? But after meeting with us, we feel like we can have a affordability budget for home buying at, let's say, $3,500. So that's where I think I can set my housing budget at monthly. Well, that's a $1,500 difference, right? So if I'm lacking savings today for home ownership, what I would encourage that client to do is let's start making ourselves a mortgage payment today in the form of savings, right? So when I'm making my $2,000 rental payment this month, take that additional $1,500 that I think I can afford from a mortgage perspective, and let's get in the discipline of distributing that into my savings account. So first of the month comes, write the $2,000 or distribute the $2,000 rent payment, $1,500 goes to my savings account. And as I develop that discipline, that savings grows over time. In 6 months, I'm at $9,000, 12 months, I'm at $18,000. That really incrementally grows over time, not including interest that we're going to pay. So it does that, but it also creates that discipline and rhythm, if you will, of making a mortgage payment. Because as we learned earlier in our rent versus buying analysis, like it's going to be a jump up from rental versus homeownership for most buyers. So if I can create that rhythm of payment and savings, it's going to make that transition from renting to buying that much easier for us. Now, we kind of talked a little bit about the Dream for All program in the state of California that I think maybe some of you are familiarized with, at least based upon the question that we have earlier. I want to spend some time talking about the CalHFA suite of products, which CalHFA stands for the California Housing Finance Agency. We're proud to be the #1 partner in lending with CalHFA across the state. So we get a chance to help the most first-time buyers with these product resources. And I want to spend some time talking to you a little bit about what these look like for you as a resource. CalHFA is designed to support low to moderate income households in home ownership. And most of the income limits for these programs are up to 150% of the median income for whatever county you want to purchase in. So the first product is the CalHFA with MyHome assistance program. Allows you to get up to 3% of your sales price in assistance on a conventional loan, 3.5% on an FHA loan. So kind of falls in line with what we talked about in our product analysis earlier. Essentially what that assistance is, it's a 1% simple interest rate loan that does not need to be paid back until you either decide to sell your home or if you were to refinance in the future. So again, it's a separate loan at a 1% simple interest rate loan. Now, next month on March 17th, CalHFA is going to launch another product called the CalHFA Access Program. That's going to allow us to do a first mortgage, but also layer in the MyHome Assistance Program that we just spoke of, and an additional 2.5% of the loan amount in closing costs or down payment assistance. That's another 1% simple interest rate loan. So that will launch next month. That hopefully will come with it lower interest rate options for the buyer as well too. And then we also have in play today is the ZIP Assistance Program that is an add-on to the MyHome product today. That's a 0% interest product, but the challenge with ZIP Assistance in today's market is with the elevated interest rate levels we have today, it actually pushes the first mortgage rate up pretty significantly. So our hope is that with the Access product, it'll give us a little more competitive interest rate on the first mortgage. One of the other benefits with the MyHome Assistance Program, just to jump back a little bit, the first mortgage interest rates on the first-time buyer program tend to be a little bit lower than a standard conventional loan in today's marketplace. Now, there's other products available too for different first-time buyer needs. We have a private labeled pathway product under within APM. There's also the GSFA program. It stands for the Golden State Finance Authority. And then Fannie Mae and Freddie Mac also have low-income housing assistance options available as well too. So there's a lot of different resources available. We'd encourage you to get connected with us to learn a little bit more about which product is the right match for you. And I want to share with you just a quick example of how the conventional product would look a little bit different if we included the CalHFA assistance. So if we looked at our example of, let's say, a $700,000 purchase price, we know the minimum down payment is 3%. And if we factor in closing costs of 2 to 3% of that purchase price, a buyer using a standard conventional loan would probably need $35,000 to $42,000 out of pocket. Okay, so for most of our first-time buyers, might be a bit of a stretch. And so if we can insert CalHFA MyHome, for example, that would allow a buyer to get $21,000 in assistance and then be able to reduce down that out of pocket to something to maybe $14,000 to $21,000. If we're able to layer in, let's say, the Access product as well, that's another 2% assistance. So then, someone could get up to $37,000 in resources to help reduce down that out of pocket expense. So these things can be really big game changers for our first-time buyers and make homeownership just so much more of a near-term goal for our first-time buyers. So I'm gonna take a couple questions in the chat, and then we're gonna go back to eligibility requirements. So one is what is the income requirement for CalHFA and MyHome? So it depends on the county that you're in. I'm gonna show you on screen in just a minute the county limits, so you'll be able to see that. There are also low income limits if someone wants to or can participate in low income options with the CalHFA product. That is at 80% of the income, median income, but most of the product is at 150% of the median income. And then the other question was, will using the minimum down payment affect the mortgage interest rate? Not when you use a first-time buyer product like CalHFA. So we talked about interest rate characteristics earlier, like if I put lesser down payments or I have a lower credit score, that would influence my interest rate, not when you use the CalHFA product. So for most of our buyers that are putting, let's say, the 3% down minimum option, if we were to side-by-side compare a conventional 30-year fixed mortgage without first-time buyer assistance versus CalHFA, it's going to be a pretty drastic difference. We're probably looking at 7.25 to 7.5 standard conventional loan versus the CalHFA loan today was at 6.875%. So pretty significant difference. So here's the minimum credit score requirements for the program. Minimum credit score of 640 for the FHA product, 680 for the conventional loan product. The debt to income ratio, which we just learned about, has a maximum debt to income ratio of 45 to 50%, depending on where our credit score is. One of the unique things about CalHFA when we consider the income limits, it's based upon the applicant income, not the household income. And so that's a really important feature because let's say I'm going to purchase in LA County. Well, LA County's loan limits or income limits are $194,000. If my income alone is, let's say, $190,000, but my spouse is $100,000, I could potentially apply in just my name and stay within the income limits and still qualify for assistance in LA County. Now, a first-time buyer is someone that hasn't owned a home in the last 3 years. Okay, so I may have had a property that I owned 6 years ago. As long as I've been renting for the last 3 years, even if I had a rental property back then, I'm still considered a first-time buyer. Now, here are the eligible properties on screen. You can see basically it's every 1 unit property is eligible, even manufactured homes, but the manufactured home cannot be in a park, and it has to be 1976 or newer to be eligible, or after 1976. So we had a request in the Q&A, which was, what are the income limits? So we wanted to give you a little snapshot of the income limits by county in Southern California. We can put a link in the chat too with the income limits based upon the CalHFA website. So depending on where you're at in the state, if you're in Northern California, let's say, for example, you're in Santa Clara County, that has actually the highest income limits in the state, which is 300,000. If you're in Sacramento County, I believe it's 225. So it does vary based upon where you're going to purchase in the state. Do we have any other questions on the CalHFA program? Because I want to kind of walk through the buying process next. But any questions? I know we had the Dream for All question. I think I've covered that. Dream for All, by the way, just so you have some awareness around that, Dream for All was a lottery-based program. There was 2 funding waves with Dream for All. There was kind of a 1.0 version back in 2023. That was a first come, first serve program. Then we transitioned to more of a lottery-based program in 2024. Currently, vouchers are being allocated for the lottery. To be able to participate in that program, you would have had to apply to the lottery last year. So unfortunately, it's not active at this point. It may come back online at some point, but in my conversations with CalHFA, even up as just of 2 weeks ago, we currently don't have any funds available on the budget from the state because this comes from the state's general fund, unlike the other CalHFA products. Okay, let's talk a little bit about the buying process. So after tonight's class, hopefully you're encouraged by what you've heard and maybe want to be on the path towards home ownership. And whether that looks like a year goal or a 3-year goal or beyond, we want to be your partner along this journey. So we'd encourage you to get connected with me for a consultation. And that consultation is a 30-minute free service we provide to our clients to design that home buying plan. Now, what comes out of that meeting was step 1, which essentially is to be pre-approved for your home purchase. And a pre-approval essentially is a document that indicates to a seller that your financing is secured, that you've had your credit reviewed, your income, your assets, your program type, and you're ready to make offers on homes. That pre-approval is usually good for 60 days, but it can be easily recertified at any time. So there really is no rush to go out and find a home right away, but it is time sensitive just because financial documents expire at some point. Now, once we've issued that pre-approval and figured out our loan program option, then we're going to start that home search. Now, that could start online. It could be right away, going out looking at homes at an open house, whatever that looks like for you. But ultimately, step 2 is the house hunting phase. We'd encourage our clients to get connected with a local realtor that should be an expert in the market, understand the local environment, understands how to negotiate, and has partners that can organize inspections for that house. We do have a trusted preferred realtor network that we can always connect you with as well too, but we encourage you to work with a professional at step 2. Now, as you're out looking at homes, you may find a few homes that spark your interest, and you may decide to make an offer on a home. Well, it might not happen on offer 1, but maybe it happens on the next property that you have an accepted offer with a seller. And what that means when your offer is accepted is that now you've engaged in an agreement with the seller, and it opens escrow for the process. Usually from the time of accepted offer to when time I get my keys, which is the most exciting day, right? It takes about 30 days on average. Now, it can be as short as 14 days. We have a quick close program that can condense that to 14 days. On average, it's about 30, even as short as 21 days. But at step 3, that means now I'm starting my real lending process. Now, the seller has accepted my offer. Within 24 hours of that acceptance, you're going to hear from me congratulating you on your accepted offer and saying, guess what? You did it. Let's talk a little bit about what to expect as a go forward. We're going to kind of go through next steps. We're also going to meet up for what we call a follow-up consultation to do a one-on-one and just reaffirm all the details of your financing. What do interest rates look like, my payment, my out-of-pocket expense, the really important features of your loan, and then essentially deliver disclosures to you. Now, you have an action item as a buyer at that point, which is to deliver a deposit, which essentially is going to be 1 to 2% of your sales price. It's basically a good faith investment in the purchase. And that money is going to be protected because it's a good faith investment in the purchase, but it's protected by what we call as the contingency period. So in a purchase contract, you have a timeline of when you're closing, but you also have a timeline in when you're doing your homework on the property or due diligence, right? So it includes getting your appraisal done by your lender. So we would order an appraisal within 24 hours of your accepted offer. We want to make sure your house is appraising at a value that supports what you're buying it for. You also want to get your home inspected, and that's where a realtor would organize inspections for you to make sure there's no potential issues with the home. And then we would also want to get your loan approved. So those activities will all take place and be finalized generally within 17 days of the accepted contract date. So you as a buyer have protection of your deposit that if something maybe just doesn't add up for you in those investigative work, that you can exit the contract and be able to get a refund of your deposit. Now, as we're kind of moving along in this process, step 4 brings us to some of the administrative functions of the loan, like the processing of the loan to verify employment, verify assets, make sure all the product is set up properly. And we kind of get everything packaged and ready to go for the underwriting team to do their analysis. Now, during the escrow process, we're going to be talking about strategy of locking in your interest rate. So once you have an accepted offer with the seller, we can then lock in your interest rate. Now, interest rates do change by the minute. In fact, during the financial trading day, they can change from 6.875 to 7%, all in just like that. Now, there's strategy to locking in that interest rate as we're going through the process. So we're going to talk about economic conditions and kind of give you our perspective and when we think we should lock in the interest rate. But that rate will get secured once we're in the middle of the processing of the loan. Step 5 is the loan approval phase. That's when the loan has been approved by an underwriter. That gives us just the validation that all the assets, the income has all been reviewed, the product's been accepted. And so that basically finalizes that at step 5. It also brings us about 3/4 of the way through the process. And at that time, at step 5, we're going to issue to you a final closing disclosure that ultimately gives you a 3-day cooling off period before we get to the final milestone. Now, with regards to disclosures in the buying process, you get disclosures from us as the lender throughout different iterations of the buying process. There's initial disclosures that are delivered within 72 hours of the acceptance date. There's also another set of disclosures once your rate is locked on your mortgage. And then once we get to step 5, another set of disclosures, which is your final closing disclosure. So once that 3-day cooling off period has elapsed, then we get to step 6, and that's the in-person process where you actually meet with a public notary. It's called the closing of the loan, and you meet with a notary to sign final loan documents. That takes about an hour or so. You also deliver the final funds needed for your home purchase. And after that's done, then us as a lender will wire in the final funds for your home financing. Those monies get reconciled with an escrow team, and then documents get recorded with the local county recorder's office. They generally record a grant deed that transfers ownership from the seller to you, the buyer, and then finally a deed, which is the loan for the home financing. Once all those recording confirmations come in, then we get a chance to make our favorite call of the day, which is to say, congratulations, you're now a new homeowner. Best call of the day I get a chance to make. It's truly a celebration, right? To go from taking a class like this to getting pre-approved to finding the home of your dreams to getting the keys to your home of your dreams is a big deal. So we want to celebrate with you. And it's not just a one-time thing with us. This is a long-standing relationship with us. We have what I think is a really comprehensive aftercare program. So after you get the keys and you get a chance to move in and settle in your home, we're staying connected with you. We have our Rate Watch program that's going to watch for refinance opportunities in the future. We have our HomeBot system that's going to monitor activity levels for your home from a value perspective and, again, refinance opportunities, and then do annual check-ins with you just to see what's going on with your home. This is, again, going to be the biggest financial decisions you decide to make. So it's not just a transaction for us. It's truly a relationship with you over time. Now, if you're thinking about moving forward in the home buying process, we would love to be that partner with you on that path. And so we're going to give you some of our get started information here. It's a really simple 3-step process where you complete an online application. It's only a soft credit check. And the application will then have you upload proof of income and assets that we've shared with you earlier this evening. And then you'll use our scheduling system to do your video consultation time directly with me. That's a one-on-one session I do with every client across the country that we work with that attends our classes, because it's a big deal. We want to make sure that we take the care and attention to design that right home buying plan for you. Now, after tonight's class, you may have some follow-up questions, and that's totally great, because we'd love to be able to get connected with you to answer those questions. If you're not ready for a consultation, that's okay. If you want to just kind of go through some scenarios, we love to get connected with you. You can set up an introductory call also on our scheduling system. This is what a consultation looks like. It is a free service we provide. Whether you're ready to buy now or buy in the future, we just want to be a partner with you. Here's what you're going to learn in that consultation. We're going to look at, where do I want to buy? Let's set up your budget. Let's talk a little bit about credit, what programs match based you're qualifying. And then should we look at some assistance programs to help support you with different resources as well? So we'll do all of that through that home buyer's consultation. And then if you're kind of thinking about, what does this look like for me, or you want to start that process, we'd encourage you to check out some of our resources on mobile as well too. In fact, you can start that process right on mobile. That's compatible with Android and Apple devices. Allows you not only to start the process right there, but you can also run payment calculators. So if you're out looking at a home and you say, gosh, I wonder what that payment looks like for me, you can hop on mobile, get all that design work done right there. It also will push notifications to you when you start the process of home buying. All right, so that's some of the other resources we have available to you. And as we're kind of getting to the end of class, we're actually right at the top of the hour. I do want to thank all of you for attending tonight, and we're really grateful for the partnership we have with UCI alumni. We used to teach these classes right on campus in the Alumni Center. And of course, we've scaled to more of a video virtual environment to be able to serve more in our local communities. But I do want to remind you, as part of our partnership and beyond our consultations that we do, we give you a discount in our services, whether purchasing a home or even refinancing in the future. Because we want to make sure that we take good care of you and creating affordable home ownership for you. These classes are always available to anyone, even outside the UCI network. If you have friends, family, coworkers that think would enjoy this content and benefit from it, have them come check out some of our upcoming classes. We have another 50 classes scheduled for this year. You can see our full class schedule at mortgageeducate.com. And here's all my contact information as we're wrapping up. So if you have some questions, don't hesitate to shoot me a message, give me a call. We'd love to be able to get connected with you. And of course, you can book your upcoming consultation or introductory call using this link on screen. And of course, we have our social channels that you can find all of our great testimonials from clients. We like to really celebrate home ownership. And then our social platforms provide a lot of great value that will share with you kind of things that you should learn or know as you're taking these next steps towards home ownership. Well, as we get towards the end of class, or as we're wrapping up class, I should say, I do have a few questions coming in, so I want to take those. And one of the questions I had was, what are your thoughts on buying a duplex as a first-time home buyer? And that can be certainly a great option. I think the goal, I would assume, for purchasing a duplex or a 2-unit property would be able to create some income to augment your overall housing expense. So, if my mortgage payment's $4,000 a month and I'm renting the other unit for $2,000, then my net savings or my net outgo is $2,000. So, I think there is some benefit certainly in this market for doing that. Just keep in mind, first-time buyer programs won't be compatible with a 2-unit property. It does have to be a 1-unit property. But on a conventional loan, if you're buying a 2-unit property, the down payment goes to 5%. So I don't think we noted that earlier. You can use an FHA product, which is a minimum down payment of 3.5%, even if you are purchasing a multi-unit property. All right, great question for that. And I do see, a lot of people looking at that as an option. One question does come up is ADU units. So ADU stands for accessory dwelling unit. ADU units can still qualify under a 1-unit property. So they are compatible with first-time buyer programs. So if you want to look at a single family residence, for example, but then there's an ADU in the back, and your plan is to rent out the back ADU, you could certainly use that for your personal income, but it won't help for qualifying, but it is compatible under a first-time buyer program. All right. Any other questions from the audience? Okay. All right. right. I don't see any other questions coming in. Again, we got class. This class has been recorded, so it'll be up on our YouTube channel tomorrow. We'll give you all the presentation material so you have that since you've signed up for tonight's class. I really appreciate everyone joining tonight's class. I know you have other choices to make on a Tuesday night, but hopefully this was informative for you. I really hope we get a chance to get connected for your upcoming homebuyer consultation and look forward to helping you on that path towards homeownership. Have a great night.